Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, November 22nd, 2024. 2 weeks ago, I said consumer spending is especially important right now. I went on to state, perhaps the single most important data point for right now is daily retail sales. I closed by noting that recent economic data could create an overly optimistic environment for the stock market. That point was driven home 2 days ago when big box retailer Target released its third quarter results ended October 31st. Those numbers included a nearly 12% decline in Target's adjusted earnings per share compared to last year, despite a slight increase in comparable store sales. The company also guided for flat comparable store sales during the fourth quarter. Now, those kind of numbers don't win a business many friends on Wall Street. That morning, Target opened at $128 a share after closing near $155 the day before. Since then, it fell below $121 before finding a bottom. That is its lowest price since a year ago and puts it back to where it was 5 years ago, before the onset of the coronavirus pandemic. So here's a chart of Target. Right now I have it out to 5 years, so you can see way over here on the right, you draw this line all the way across. It just touches basically back to where it was just before the pandemic. And if we zoom on, let's just go say year to date. Again, you look at the spot way to the right, you can see the magnitude of the drop. Now clearly that's bad news for Target shareholders. Until a few years ago, Target's management team was considered one of the best in the business. The company responded effectively to the threat posed by Amazon by retooling its stores and beefing up its online presence. None of that seems to matter anymore. Instead, Wall Street zeroed in on the company's statement that consumers are spending less money on discretionary items. If that is true, then it might signal the shift in consumer behavior that I warned about 2 weeks ago, in which case the entire stock market may have a problem. However, I'm not so sure that is really the case. Target also acknowledged that it added more inventory during the quarter than it sold. My guess is that excess inventory consists of the discretionary items that still sit on its shelves. If so, then Target's fourth quarter sales figures may also be adversely impacted, since those items will most likely need to be discounted to unload them. Target's other huge rival, Walmart, did not have an inventory problem during the third quarter. In fact, the company exceeded its guidance for sales and earnings per share during the quarter and raised its guidance for full year sales. Since releasing those results 3 days ago, its share price has gained ground while Target plummeted. So again, here's Walmart, and this is over the past 5 years. Now let's zoom into year to date to give you a more recent kind of frame of reference. And Walmart didn't skyrocket after that news, but the point is it was gaining ground while Target was losing a lot of ground. So it just kind of calls into question to what extent consumers are being, say, not spending, or just what they're spending on. So I think the real lesson here is that consumers are spending cautiously, but they are still spending. For all we know, Target simply misjudged demand for the higher margin discretionary items that it loaded up on during the third quarter, while Walmart got it right. In that case, Target's misfire may not be indicative of anything other than the importance of correctly anticipating consumer sentiment while Wall Street's nerves are on edge. That's this week's PF video update. I look forward to talking to you in another week. Thank you.